As a trader in the financial markets, you've most likely already heard about this strategy that has become essential in SMC, order blocks, a concept popularized by ICT, which has proven itself and attracted thousands of traders around the world. But here's the problem. With its rapid success, many traders started using order blocks without truly understanding their rules, their logic, and most importantly, the validation criteria. The result? Rushed entries, false signals, and significant losses. That's exactly why I made this video. Today, I'm going to show you, in a simple, clear, and practical way, everything you need to know to identify a truly valid order block according to ICT's methodology, and avoid the traps that 90% of traders fall into. If you want to stop marking order blocks at random and start using them with precision and confidence, then this video is for you. Before we dive into the details, let me quickly show you exactly what we're going to cover in this video, step by step. In this video, 1. We'll start by clearly defining what an order block is. 2. Then, we'll talk about the different configurations of a standard order block. 3. After that, we'll break down each configuration in detail so you fully understand how they form. 4. Next, we'll go over the key criteria you must respect to identify a truly valid order block. 5. And finally, we'll see how to enter trades on an order block with precision and proper execution. So, if any of these points interest you, make sure to like the video, subscribe to the channel, and watch until the end, because every part matters. So let's start with the essentials. What is an order block, simply, and why does it appear in the market? Let's start with a simple definition of an order block. An order block is the last opposite candle before a strong and impulsive move in the market. It represents a zone where institutions placed large orders, which caused price to accelerate aggressively in a specific direction. In even simpler terms, an order block shows us where smart money truly entered the market. Why does an order block form? Order blocks form because institutions cannot execute their positions all at once. Their volume is too large, so they must accumulate or distribute their orders gradually. When price leaves an area with strong momentum, it indicates that a large number of orders were executed in that zone. That's why, when price returns to this area, it often acts as a reaction zone, as institutions look to protect or rebalance their positions, creating high-probability trading opportunities. Now that you understand what an order block really is and why it forms, which brings us directly to the second point, the different configurations of a classic order block. It's time to learn how to properly identify it on the chart. Because a valid order block is never drawn at random. According to ICT, it always relies on a very specific structure. The classic order block configuration, according to ICT, an order block is made up of 3 essential elements. 1. BOS, break of structure. 2. FVG, fair value gap. 3. Liquidity. These 3 elements together define a valid order block. If even one is missing, it is not considered an order block under ICT logic. Talking about the configurations without going into detail won't be very useful because many traders still can't properly identify a real BOS, FVG, or liquidity. That's why we're going to take a short detour to explain these 3 configurations in a simple and practical way. 1. BOS, break of structure. A BOS happens when price breaks a previous high or low with the candle body. Valid example, price breaks with the body of the candle, confirming the BOS. Invalid example, if the break is only with the wick, it's not a real BOS. 2. FVG, fair value gap. The FVG is the gap left between the wicks of 3 consecutive candles. This gap is called a fair value gap and price often returns to fill it before continuing its direction. Valid example: price did not close the gap before continuing, confirming the FVG. Invalid example: if price returns and closes the gap before the next impulse, it's not a true FVG. 3. Liquidity. Liquidity is the last move that creates a false breakout before the main impulse. It's when smart money triggers stops, other traders' orders, to then push price in the real direction. In other words, liquidity shows us where institutions manipulated the market to accumulate or distribute positions before the actual move. For example, here we can see how this extended wick moved down to collect liquidity before price continued upward. In the second case, however, liquidity was not collected, which explains the lack of a clear bullish reaction. Now that we understand the different configurations, let's see how and under what conditions we can say that an order block is valid and offers a higher probability of success. But before we continue, I invite you to like the video and subscribe to the channel if you haven't already. Key criteria to respect for a high probability order block. 1. Market trend. Like in most trading strategies, it is very important to trade in the direction of the market trend and never prioritize an order block that goes against the trend. In a bullish trend, focus only on bullish order blocks. In a bearish trend, focus only on bearish order blocks. Never do the opposite. 2. Internal liquidity. After identifying an order block zone in the direction of the market, the last key element we need is internal liquidity. For a bullish order block, this liquidity is usually found just above the order block. For a bearish order block, it is usually found just below the order block. This internal liquidity is what confirms that price is likely to return, sweep that liquidity, and at the same time trigger our entries inside the order block. To make sure you truly understand, let me now show you a practical example directly on a real market chart to prove the effectiveness of order blocks. Our example comes from the Euro-Yen pair on the H4 timeframe, covering the period from December 2nd, 2024 to February 7th, 2025. You can verify this yourself after watching the video. Now, let's apply everything I've taught you in this video, but let me walk you through it step by step, because my ultimate goal is to help you truly master order blocks. Step 1. Identify market structure and trend. First, we can clearly see that the market was in a bearish trend. Then, we observed a COCH, signaling the end of the bearish trend and the beginning of a bullish trend. First rule: respect the market trend. Confirmed. From that point on, our only focus is to identify bullish order blocks only until the next trend reversal. Step 2. Wait for a valid order block. The next step is to wait for the formation of a valid order block, which includes a BOS, a FVG, and liquidity, followed by internal liquidity. Step 3. Market reaction. And that is exactly what the market did. Price first swept the liquidity located in this area, then moved impulsively, creating a BOS, confirming the bullish trend. After the BOS, the market left a FVG, followed by internal liquidity, and then returned precisely into our order block zone. From there, price moved up very aggressively, clearly demonstrating the power of this strategy. Important observation. More observant traders may notice that when price returned to the order block, it actually created a new order block. The principle remains exactly the same. Wait again for all confirmations, BOS, FVG, and liquidity before entering a trade. Example summary. Each time, the same sequence repeats. Price collects liquidity, creates a BOS, leaves a FVG, followed by internal liquidity. This logical repetition is what makes the order block strategy clear, structured, and effective when applied with discipline and patience. Once all the conditions are met, market trend, valid order block, and internal liquidity, there are two main ways to enter a trade on an order block. 1. Direct entry with a limit order. The first method is to place a limit order directly inside the order block zone, right after the internal liquidity has been formed. Advantages. Very often, price tests the order block and immediately moves away in the direction of the trend. This method is simple, fast, and effective when the market is highly impulsive. Disadvantages. Sometimes, price returns deeper into the zone and may even slightly break below or above the order block before reversing. In that case, our stop loss can be triggered, even though price eventually moves in the expected direction. 2. Entry after confirmation with a COCH, change of character. The second method, which is more precise, is to wait for price to return into the order block zone and then enter only after a COCH forms. A COCH, change of character, is a shift in market structure, and it often signals a potential trend reversal in the expected direction. Execution process. Price returns into the order block zone. We then drop down to a lower time frame to look for the COCH. Time frame combinations examples: daily, H1, H4, M15, H1, M5, M15, M1. Identifying a COCH on a lower time frame allows for sniper entries with tight stop losses and a high risk-to-reward ratio. Entry methods after the COCH forms. Once the COCH is confirmed, you have two options. 1. Enter immediately at market after the COCH forms. 2. Place a limit order on the last opposite candle that created the COCH, hoping price will return to trigger the entry. In both cases, the entry happens only after the COCH, inside the order block zone, and on a lower time frame. To wrap things up, remember this. Even with all the possible confirmations, trend, valid order block, liquidity, COCH, and proper timing, a trade can still fail. The financial market is not an exact science. It operates on probabilities, not certainties. That's why money management is more important than any strategy. A good trader doesn't aim to be right on every trade, but to protect capital and stay consistent over the long term. So, always respect your risk per trade, accept losses as part of the game, and focus on proper execution, not emotions. If this video helped you better understand order blocks using ICT logic, don't forget to like, subscribe, and turn on the notification bell so you don't miss future videos. Let me know in the comments if you want a more advanced video on sniper entries, risk to reward, or common beginner mistakes. I'll see you in the next one. Trade smart and stay disciplined.